Asset Management, a Systematic Approach to Factor Investing by Andrew Ng provides a comprehensive framework for understanding factor investing and the principles of deploying an asset management strategy that is attuned to the realities of market behavior and risk factors. Emphasizing an analytical approach, Ng integrates academic research with practical insights on portfolio construction, offering tools for professional asset managers to enhance returns while managing risks. Here's our pick of the top 10 insights from the book. 1. Traditional investment strategies often ignore the benefits of factor investing, which can provide improved diversification and risk adjusted returns. So you've been navigating the high seas of traditional investing, riding the waves of stocks and bonds with the elegance of an inflatable rubber duck in a hurricane. Well, hold on to your monogrammed life vests, because factor investing is about to blow your mind like a leaf blower in a bubble bath. This systematic approach to asset management sidesteps the yawn inducing world of buy and hope investing by focusing on factors, elements like value, size, momentum, and quality that are like the secret spices in the recipe for financial success. Incorporating these into your portfolio doesn't just add a sprinkle of diversification, it's like throwing a whole diversification fiesta. And let's not forget risk adjusted returns, which in the realm of investing is akin to having your cake and eating it too, with 0 calories. Factor investing doesn't play hard to get, it's an open book, ready to steady your financial ship and guide you through the stormy markets with the poise of a swan on a tranquil lake. 2. The value premium, where cheaper assets tend to outperform more expensive ones over the long term, challenges the conventional wisdom that higher cost equals better quality. The value premium, that seductive finance siren that lures thrifty investors with whispers of cheap is chic. It's like finding designer clothes at thrift shop prices, anomalously rewarding. While some don lavish price tags like peacock feathers, thinking it's all about the bling, these shrewd investors know that a lower cost often hides a Cinderella just waiting for the ball. You see, it turns out that in the stock market soiree, often the belle of the ball isn't the one decked out in diamonds, but the one who was underestimated at the coat check. Cheaper assets, like the underdogs in those heartwarming movies, tend to triumph over their glitzy, overpriced counterparts over time. Save those pennies and watch them grow. It's like the tortoise and the hare, only with a lot more paperwork. 3. Momentum investing. The idea of buying assets that have recently performed well can capitalize on market inefficiencies, despite the prevalent belief that markets are mostly efficient. Momentum investing, the financial world's equivalent of the cool kids table, where assets that have been flexing their gains attract even more attention, creating a self fulfilling prophecy of success. Be with the winners, it says, and perhaps some of that winning streak will rub off on you. It struts through the efficient market hypothesis with its head held high, casually tossing aside the notion that prices fully reflect all available information. After all, who doesn't want to be seen with the investments that have been hitting the gym and showing off their bulging portfolio returns? So while markets do their best impression of the all-knowing oracle, momentum investors give a cheeky wink, ride the wave of recent winners, and just maybe outsmart the academic notion that there's no easy way to beat the market. 4. Factor investing suggests that financial markets are predictably irrational, overturning the classical view that markets are always rational and prices always reflect all available information. Well, buckle up for a wild ride on the factor investing roller coaster. Here's the scoop. It's like finding Waldo in the world of finance. The traditional suit and tie wisdom peddled the mantra that markets are these all knowing beasts, with prices as accurate as a Swiss watch. Along comes factor investing, flexing its statistical muscles, showing us that markets are more like that one friend who insists they're fine while clearly stress eating chocolate. These factors are the breadcrumbs that lead savvy investors through the forest of financial quirks, hinting at where the returns might be hiding. And oh boy, do they love to play hide and seek. So the next time someone says the market is rational, offer them a chocolate and a good book on factor investing. 5. Incorporating environmental, social, and governance (ESG) factors into asset management can lead to better long term financial returns, defying the myth that ethical investments underperform. Picture this: investors donning green capes as they swoop in, not just to save the day, but perhaps their portfolios too. Who said chivalry was dead? The ESG knights in shining armor show us that you can joust with societal woes and still end up with a chest of golden returns. Ethical investing's rep as the underdog is seriously outdated. It's like hanging on to a BlackBerry in an iPhone era. With ESG factors, you're not just betting on companies, you're handpicking the future guardians of our planet and society. Plus, they're businesses that sidestep regulatory risks like a ninja avoiding flying stars. So forget the myth. ESG's got the muscle to boost those long term gains. To sum it up, the book Asset Management: A Systematic Approach to Factor Investing highlights how factor investing, through methods like targeting the value premium and momentum strategies, can defy traditional market wisdom and yield better risk adjusted returns, while also showcasing that ESG integration can enhance long term financial performance. Thanks for watching.